Thank you
All
very
right.
much. Thank you very much, Amy. And also joining Amy today is Brian Thompson out of our Fargo office, and so we thank them obviously for any and all help that they give us. Each one of our webinars, they do really, really wonderful work. So today's webinar again is the second part of our revenue and expense recognition series on the GASB's preliminary views document. We held our first part back in February on chapters 1 to 3. Now, if you missed it, you can get a replay of that webinar on our website. But we'll do a quick overview just in case you missed it over the next few minutes, a real quick overview. The comments on this document were due a few weeks ago on February 26th, but as a reminder, GASB will still accept your written comments if you want to provide something. And then furthermore, this is only the second stage of a four-stage project, and there's going to be an exposure draft on this one coming out, assuming it goes forward and doesn't go back to square one. It'll be out probably by the end of next year. So it's important to realize what is going on and understand the issues that are involved with revenue and expense recognition. Public hearings are going to start up next week. I actually have a testimony slot coming up on the 23rd. That'll go until the end of April. And then deliberations, as I mentioned, will go at least another year. So we do have some time. So let's go through the agenda. Again, we're going to do a quick review of what we mentioned in February about the conceptual framework, just in case you missed it. And then we're going to do a deep dive this hour into categories A and B on the revenue side as proposed in the preliminary views. Now, as a reminder, the GASB is attempting to be as symmetrical as possible. Once we review the revenue side, the expense side coming up in April's webinar will be pretty easy peasy. Two things we'll spend on during a few minutes today. What the GASB's view was, it will be on non-compliance with purpose restrictions. You know those better as question costs and grants. That's going to be really important. And then finally, for the municipal governments out there, the revenue side of general aid and shared revenue transactions. As most of you know, those transactions are a significant portion of a lot of municipal governments' revenue streams. So that's really important stuff this hour. So let's take a quick walk through the conceptual framework, or as I like to call it, the true north. But we're going to apply it to the revenue side of the flow statements in this hour. As I said last month, you'll see these repeatedly. So here are my 5 true norths that are within the preliminary views. First, revenues and expenses are of equal importance in the resource flow statements. And we'll delve into these a little bit in a little bit. The second piece being revenues and expenses should be categorized independently and are not in relation to each other. The third piece is for accounting and financial reporting purposes. The government is an economic entity, and yeah, you vote in the government, and the government is us, but it really is legally separate from all of us. The fourth piece is symmetry should be considered to the best extent possible in the application of the revenue and expense model. And then finally, as the GASB is making pronouncements with regard to revenue and expense recognition, they want to take a consistent viewpoint from the resource provider perspective, and that should be applied in the analysis of revenues and expenses. So let's break these down a little bit, as I promised. The GASB has an initial view that recognition of a revenue or an expense is not influenced by a related revenue or expense. So that dispels a legend pretty immediately 5 minutes into the webinar. And again, it is just a legend that the matching principle applies to state and local government accounting and financial reporting. I learned this in school. You learned this in school. My professor was wrong. It has never been in GASB GAAP. It is only in some, but not all, private sector accounting standards. That approach effectively subordinates expense recognition to revenue recognition. Here in government accounting, we use this thing called interperiod equity as the key relationship between revenues and expenses, because it helps all of our users of our financial statements, whoever they may be, gauge whether current year revenues are enough to pay for services provided that year. So for that reason, the GASB concluded that revenue and expense recognition is done independently by relying on particular definitions. Now, we consider periodicity more than anything. And I know you worry about that in terms of revenue and expense recognition and, of course, your budget. We really focus on periodicity. And again, did revenues or expenses apply to this reporting period? And it's why we have these things called deferred outflows of resources and deferred inflows of resources. Next, revenue transactions are categorized independently from the programs that they fund. Now, this may be different from what you believe. You may categorize expense transactions based on the category of the source of funds. But think about it in your local community. Does your community government provide fire services solely if, property or other taxes are available to provide those services? And the answer is no. In governments where fire services are business type activities, well, then perhaps yes. But in most other governments, general revenues pay for fire services. And many of our operations are not strictly fee for service. Finally, governments are separate from other governments and the citizens that create the government. And yes, I used to be a public servant before I went into the private sector. And yes, public servants work for us as citizens. However, the accounting is different, and revenues and expenses are not netted with net amounts reported to us without some form of understanding of what derives that net amount. Now, based on what we're learning as a lot of us are implementing GASB 84, our governments are not in a fiduciary capacity over tax revenues and general government expenses. The GASB is attempting to minimize this net reporting with this project. And so this netting function that we sometimes do, that's going to end up going away in a lot of respects, except for maybe things like derivatives and things that are scoped out of this project. Net reporting is different than symmetry. The GASB wants to convey that symmetrical principles should be developed for categorization, recognition, and measurement proposals that are applicable to revenues and expenses. Now, this may be different than what we're doing now, especially in the transactions that we do every day that are the result of estimation. After all, the estimation process for uncollectible taxes is done differently by each government. So, what the GASB is trying to do is to establish a framework to figure out that categorization rather than solely relying on estimation. Finally, the GASB wants to have a consistent viewpoint of recognizing revenues and expenses. Now, if your government is a receiving government for a grant, as many of us are this year, especially after CARES Act and now ARPA is coming up, the recognition of revenue should be the same as other governments receiving the same grant. Now, if your government is a paying government for that same grant, your government's expense recognition should be the same as other governments doing the same thing. Guess what? It's currently not the case. And so that's why GASB's doing this stuff. So let's apply those true norths to the revenue side. The GASB has an initial view of two categories of transactions within scope. After major deliberation going back and forth, I think that for a while it was called apples and oranges. Today we call this, We call this exchange and non-exchange transactions. After a lot of deliberation, the GASB put on the board categories A and category B. Both categories of revenue recognition are based on some form of legally enforceable claim. Such claims are based on either the government having to do something in order to recognize revenue, and that's category A. So again, does the government have to do something to get revenue? And if the answer is yes, that's category A. Or there is some force of law, regulation, or other compliance aspect, and that's category B. Pretty easy, it seems, until you peel away the onion. Now, most fee-for-service arrangements are probably going to land up in category A. In other words, for example, does your municipal water district, did it deliver water to the customer? Does the municipal electricity district deliver power to the customer? Now, I know some folks out there, that's a little bit of a question these days after the ice storms of about a month ago. Was a lottery ticket purchased? Was a payment made for tuition to be made for the next semester, even considering the last day to withdraw? Was a valid service provided by a doctor in order to claim Medicaid reimbursement? Those are all going to be category A, assuming this goes forward. Now, again, as you can tell, category A transactions are separated by these distinct goods or services. Each distinct good or service entails a binding arrangement. In other words, did the government perform a service in exchange for some form of fee revenue? Now, the good or service may or may not come with some form of performance obligation, meaning did the government do what it was supposed to do in accordance with the contract? If the answer is yes, then the revenue can be recognized, including perhaps over time. Think about it. For example, let's say you're constructing a building and you happen to be a government that does a lot of construction on behalf of other governments. Now, you're going to recognize revenue from that other government probably over time based on some form of milestone. At each point in time that the performance obligation is satisfied, let's say in that construction, then assets are then transferred to the other party in the transaction. And the other party might be a not-for-profit or some other organization or another government. The rest would be then category B, as they have forces of law, contract, or regulation. The vast majority of these now we know as non-exchange transactions. In non-exchange transactions, the value does not need to equal the services provided. Again, focusing on fire services, a fire service to an individual's house is worth way more than the property taxes paid by the homeowner to fight a fire at the house. Category B transactions are proposed to include voluntary, imposed, derived, contractual, and government-mandated non-exchange grants and taxation. It's also proposed to include shared revenue, meaning taxes and fees that are collected by one level of government and apportioned to another level of government. It also includes general aid provided by a state government, as an example, to another level of government, but the reverse could be true. Property taxes, purpose-restricted grants, and similar, those are going to be category B transactions. If a category B transaction has a time element involved, as many grants and taxes do, a deferred inflow of resources would result. So focusing on taxes, for example, if taxes are levied in 1 year, but cannot be spent that year, then the amounts received or receivable would result in a deferred inflow of resources until the time restriction has passed. And for my friends in Colorado, that's of course embedded in your Constitution. That's Tabor. To recognize revenue, then 4 steps are included and as on the screen. Step 1, does the government have an increase in net assets? Step 2, does the increase in net assets result in a related liability? Step 3, does the increase in net assets result in an inflow of resources applicable to a future period? And if the answer is no to all steps 1, 2, or 3, recognize revenue. Now, for those who need a visual, here it is. If no increase in net assets, then stop. Do not pass go. Do not collect $200. I know I'm dating myself. That's monopoly. No revenue. So if you don't have an increase in net assets, there is no revenue transaction to recognize. If there is an increase in net assets, but it also increases a liability, such as a deposit or an advance, then that's your transaction. Debit asset, credit liability. Now, if that's not your transaction, is the increase in net assets applicable to a future period? If yes, then your credit would be to a deferred inflow of resources. If no, then your credit is to revenue. So I know what you're saying. You're saying, Eric, since GASB 63 back over 10 years ago, there's no such thing as net assets. Yes, the GASB staff know this, and the GASB staff, know that this aligns to the existing framework, which has not been updated. Now, once we get a brand new set of standards for revenue and expense recognition, however many years from now, the conceptual framework will need to be updated by any of those standards. Now, you see, we've been dealing with this boo-boo at the GASB for over a decade. So yeah, they know that this needs to be changing in the future. So now that we've reset, let's dig a little deeper into the revenue side of our transactions. In all types of revenue transactions, the GASB has a view, preliminary that is, that there needs to be some form of legally enforceable claim prior to recognizing a receivable. The government's owed funds for some form of good or service that has been provided, or some form of a force of law that compels the payer to owe the government. Remember, for now, investment transactions are out of scope, so we're going to leave those aside. Let's just stick to goods or services or grants or taxation. So again, those goods or services or taxation may be at a single point in time or over many periods. Now, let's just think about it. My town bills property taxes on a quarterly basis, but the levy is prior to the year. And that's a little different than my town's recreation program that is signing up for camp this summer. Oh, thank goodness camp is going to start back up here on the East Coast. But of course, it's still March. And further, the camp season will straddle the fiscal year end. So let's go down a little further with my town's summer camp program. We know what the debit is. Once mom and dad hit enter on the town recreation website, well, that's a receivable. And then the receivable was declared when the adult filled out the camp form and agreed to pay the town a deposit no later than 30 days prior to when camp starts up in late June. So now the parent must pay in late May. So what's the credit? GASB's view is that advances would be declared when resources are received before the legally enforceable claim arises, which would be a liability. Now let's put that into English. It doesn't matter if the deposit on the camp is refundable, it's still an advance, a deposit, and therefore a liability. It's not the same as revenue as no services have been provided. And camp does not start up around here until late June. Now, if you're saying to yourself, not too different from today, you're exactly right. Yes, some of you are maybe still be using the old term unearned revenues or similar, but it really should be an advance. And then another thing, in my newspaper, my local newspaper yesterday, it said that a lot of school districts are contemplating summer school so that kids can catch up from lost time from this year. Now, let's say that impedes on summer camp. Well, if that's the case, then having that advanced liability there is actually a good thing that the local government didn't declare revenue. So all they'd have to do is effectively reverse the transaction for all those summer camp registrants who now need to send their kids to summer school because that's what the school district decided to do. Now let's apply those concepts to revenue recognition. You can almost see it as a timeline on the screen. And should this ever come to a GASB standard or multiple standards, it's almost as if each revenue source may have to be mapped out as this one is on the screen. As we've discussed last month, we're using a performance obligation approach to category A. Remember, we must do something to get something. And we'll talk a little bit more about performance obligations in a bit. Now, category A is then recognized as we satisfy our performance obligation, and then we have some form of a legally enforceable claim. We then declare a receivable. Cash received prior to when to the legally enforceable claim, well, that's a liability. It's an advance, just like mom and dad, paying for camp, a couple of seconds ago that I just explained. Once we do something and we have some form of legally enforceable claim, we recognize revenue for that period. Now, that can occur immediately or over a span of time. Let's visualize this thing. We have a timeline. If we receive assets before a legally enforceable claim, pretty easy stuff. You debit assets, you credit advances. Again, the asset could be a receivable or it could be cash because somebody walked up to the window and paid on some form of permit or something like that. And the asset could be restricted until the services are rendered. Now, I use the summer camp as an example, but you could also use a tuition deposit, as many parents are receiving those letters over the past couple of weeks saying, hey, congratulations, your son or daughter has been accepted at ABC University. And oh, by the way, here's the tuition bill. And so you could be receiving that information. You have to pay a tuition deposit. Now, once we have that, again, legally enforceable claim, the advance is debited. But if we are unable to recognize revenue due to some force of law or time constraints, for example, in a grant, well, then we have deferred inflows of resources instead of revenue. But once those time constraints are satisfied, we debit the deferred inflow of resources, and then we credit revenue. We already have the cash or the receivable. But again, you're saying, Eric, this is probably not too much different than today. You're exactly right. What's happening is the GASB is constructing a framework which currently doesn't exist. And we've been driving a car without wheels for decades. It's the same thing. But now we're all putting it into one convenient place, putting the framework together for all of us to use. Okay, so let's go a little bit further down the road in revenue. Our category A is what we have performance obligation. And again, that's our key. Performance obligations are distinct goods or services. We got to do something to get something. Once we do something, the other party or parties we're providing goods or services to have the ability or have already received benefits from those goods or services. Now, if we're a public college or university, we've provided books required for classes in a bookstore. If we're a transit authority, we've provided bus services. Goods or services can be one thing or multiple things or a timeline of things. The one thing could be the book in the bookstore. Multiple things could be a bunch of services connected to a rehabilitation in a public healthcare facilities. The series could be providing municipal utility services to a customer for the 31 days in March. Each are goods and services and related to some form of performance obligation. Revenue is then recognized for that performance obligation. Each time someone boards a bus and swipes a monthly pass, revenue would then be generated, even though the pass was paid for in advance out of payroll withholding, if the person happens to be using that system. The government is doing something. Another example, each time you flick a light switch, you're generating income for your municipal utility department, assuming your town or city has a municipal utility department. The meter turns, and guess what? It's the same thing. If you keep the lights off and flick off all the switches that are in your fuse box, then the meter stops turning. It's the same thing, performance obligation. When you think about that term performance obligation again, is your government doing something? So let's go a little bit further. Yeah, come on, there we go. I mentioned a few of these already, but let's now put these 3 steps into practice. Each column is going to represent the types of good or service, and each row represents a slice of time. This is a good way to understand what's going on in performance obligations. So in the first column, we're using a gallon of water from our town water district. Each gallon of water used while taking a shower, the town declares a receivable based on the meter. Since the water cannot be returned, then the town has revenue. Billing is then sent at the end of the month, and at some point, the customer pays. Now, in the second column, a state building authority, which is legally separate, signs a contract with a city to build a new city hall. The city agrees to repay the state over 10 years, but based on this, on the state completing the city hall and the city occupying the city hall, because there's going to be some time for construction, of course. If the building is not completed, then no payments. There's a contract and a receivable, but until occupancy, no revenue. Upon occupancy, we have a payment stream. Finally, we have some research and development for a new vaccine. The R&D is being performed by a state under contract with a pharmaceutical company. They're doing this as the state has the patent and the technology. Once developed and approved by the FDA, the company pays the state a royalty based on the doses created. The state then is paid on those doses delivered. Now, if you think about it, that third scenario is very real, by the way. Pieces of RNA technology, which hopefully a lot of us are benefiting from. I was talking with Brian before, he has his vaccine already. That third scenario is very real. That RNA technology was developed at a public college or university, at the University of Massachusetts Medical School. And the guy who developed it, he won a Nobel Prize for it back in 2006. And part of that technology is embedded in the COVID vaccines we're all waiting for. And so that third scenario right there is very real. So let's go to something a little bit more common. Okay, I mentioned summer camp, which for the parents out there, we're all hoping and praying for this year. We have a park district with a June 30 fiscal year end. They operate a summer camp that begins on June 1st and ends on August 7th. Parent registers their child to attend the camp for 10 weeks and then commits to making payments at $175 at the beginning of each week. The parents can't get money back for any missed days of camp, and the failure to make a weekly payment would prevent a child from attending camp that particular week. On each Monday in June, the park district receives cash in the amount of $175. The week that spans fiscal years then includes 2 days in the following fiscal year. No, excuse me, 2 days in the current fiscal year and 3 days in the following fiscal year. So that periodicity becomes a little bit of a problem. And if you think about it, you know, by spanning fiscal years, that happens to us all the time in governments. Now, we learned about the 4-step process of categorization last month. And just to refresh your memory, step 1 is identification of a binding arrangement. And that camp registration document, that's a binding arrangement. It can be presumed to be enforceable by law. The registration document has some form of economic substance because once it's paid, then your child can go to camp. It's expected to result in inflows for the government. There is mutual assent between parties of capacity. Both parties approved the terms and conditions of the arrangement by registering. And the government could be bound by the terms of the registration document. The parent who registers their child, they approve the terms and conditions. And And by completing the registration process, they're bound by that terms and condition. Now, a child wishing to participate in the camp, they can't register themselves, because they're just not allowed to under law. They're too young. Now, there's rights and obligations that are identifiable. The park district has a right to consideration, meaning the $175, but they also got to provide camp services. The parent has a right to receive that camp service and the obligation to provide the payment of $175. So you can see it's an exchange. Excuse me. Determination of whether or not these rights are interdependent, well, that's step 4. We learned about that last month. The park district's right to consideration is dependent on the providing of camp services agreed upon in that registration. The parent's obligation is to provide consideration is also embedded in that registration process. So clearly, this is a Category A transaction. And again, you almost have to see these things mapped out, almost like it is here, where there are 4 steps and indeed 4 outcomes that all answer yes. And that becomes a Category A transaction. And each week, as the payments are made, then the children get to go to camp and mom and dad are happy. It's a Category A. And again, you'll see these again coming up next month. So what about the debits and credits? The payment schedule is weekly in advance of somebody going to camp. You have to pay in advance. Therefore, the park district would recognize those transactions as a liability at the beginning of the week. The park district's performance obligation is satisfied as the child simultaneously receives and goes to camp. The performance obligation is satisfied each day. Therefore, the revenue would be recognized accordingly throughout the week by day. And that gets us over the periodicity hump. Revenue would then be measured on the most liquid item, which is cash in this case, or the prepayment received. Given the terms of the binding arrangement, that would prevent children from attending without payment, collectability, no, that's not an issue. We don't need an allowance for doubtful accounts. The park district receives cash each of the 5 Mondays in the month of June, and 4 weeks and 2 days of the summer camp occurring during the current fiscal year. At the end of the current fiscal year, the park district would have a debit to cash and a credit to liability because we got those pesky July 1st, July 2nd, and July 3rd. In that week, revenue would then be recognized for the remainder. Pretty easy peasy, pretty much the same as we do today. Now, what about expenditure-driven grants? Well, those are Category A transactions too. The receiving government must perform something in accordance with the terms and condition of a grant, incurring some form of allowable costs. GASB continues to believe that once allowable costs have been incurred, a receivable can be declared as there is a legally enforceable claim. This is exactly like today. Now, had the government received cash in advance like we have in a lot of us in CARES Act relief funds, then guess what? We got to declare a liability. That's not revenue. It would be that would be the credit until we have allowable costs. Once allowable costs are incurred, such as in the CARES Act allowable activities, then the liabilities would be debited and then revenue credited. Future compliance is then not taken into consideration if the allowable costs have already been incurred. And so again, just like today with the CARES Act. Okay, that's Category A. Now, what about Category B? For Category B, in GASB's view, our key decision is based on that all-important factor of time. For example, we must use grants or tax revenues in a particular period or a series of periods. We may be barred from using the grant or tax revenues prior to or after those periods. If the grant does not have time constraints, then we fall back on whether the government has some form of legally enforceable claim to the grants or taxes. Derived and imposed revenues would then fall under those categories. Now, most of us know these and love these and have been dealing with these for our entire careers. We're talking about income taxes, sales taxes, property taxes, fines, regulatory fees, licenses, permits, you name it. A receivable would still be declared upon a legally enforceable claim, such as a tax levy. If a receivable is declared in advance of time, well, we have a deferred inflow of resources just like today. Again, Gasby's building the car when we already have the wheels. So let's go a little bit further on property taxes and fees. As we know in the financial reporting model project, the old 60-day accrual that may be going away for governmental funds. Let's leave that one a bit, and we'll talk about it a little bit more next month. But for property taxes, receivables will be declared as an imposition date. The imposition date is when a governing body approves a local ordinance or some other form of action that specifies a property tax rate and a total property tax amount that citizens are expected to be providing for a particular fiscal period. We know the imposition date perhaps as a lien date or an assessment date. Now, the GASBs try to make these things a little less legalese here for accounting purposes. We will still have the lien process for enforcing taxes when a government approves a rate or identifies a total amount of tax due from property owners. That's a lien. Once a lien is in place, we'll have some form of legally enforceable claim. And the date of imposition is the date we have in law or ordinance. And and that's the date that it was passed. The GASB believes a receivable is recognized regardless of whether a lien is attached to the property. Now, for other fees such as receivables or regulatory fees and so on, or permits, the receivables or fees are going to be recognized due to a due process of law. And it can be established that an individual or an entity has committed an act or a violation of law in which the fee is prescribed in the governing body's legislation. So if you get a speeding ticket, well, guess what? That is a due process of law once it's adjudicated. Revenue is then declared unless for some reason the fees are applicable to a future period. Now, again, if you appeal that speeding ticket, it's likely paid during the current period and certainly a receivable if you lose. So let's go down the road of property taxes a little bit. Here we got a December 31st year end. The city passes property tax, and we have some imposed taxes on November 30th, of which 2% are going to be uncollectible. Between November 30th and December 31st, some folks decide to prepay on their taxes because they're going to Florida for the winter. Now, this is classic category B. And as we only have a binding arrangement, but the mutual assent is not there. The individual property tax owner did not approve the terms and conditions, but they did vote for the folks to act on their behalf. It's category B. And here we got the debits and credits as of the 12/31 year end. Now, you may want to bookmark this or fold it back, but that's pretty much what we do today. The receivables are net of the allowance for doubtful accounts, in this case, 2%, and our debit is to cash and for the amount up front, and the rest is to deferred inflows of resources, just like today. Category B also includes contractual arrangements. Remembering our business law 101 classes in college, in a contract, we have two or more willing parties entering into an agreement evidenced by some form of explicit binding arrangement that provides for the transfer of resources, meaning consideration, between the parties. For governments, common transactions include pledges, donations at public colleges, universities, and healthcare facilities, payments in lieu of taxes, purpose-restricted grants that are evidenced by a grant agreement. Now, most of these today are voluntary non-exchange transactions. But wait a minute, today we focus on purpose restrictions or eligibility requirements on these pledges, donations, and payments in lieu of taxes. Well, category B mostly considers time. And that's why the credit in these transactions will be a deferred inflow of resources. But if there are no time requirements, though, let's say it's just a free grant from the Gates Foundation, well, a purpose restriction is the only thing to consider before recording revenue, meaning, did you do what the Gates Foundation asked you to do? For donations and pledges to public colleges and universities and healthcare facilities, the GASB's view is that a receivable would be declared once the promise is made that is verifiable, measurable, and probable of collection, regardless of whether or not there's a time requirement. So for example, let's say you have an endowment. Additionally, the GASB believes that a pledge requires the recipient government, let's say they have to raise additional contributions. A receivable then is recognized when a recipient government has met those requirements. If the pledge includes time requirements, well, then a deferred inflow of resources is declared until the college, university, or healthcare facility begins to comply with the terms and conditions of the donation, including investing for specific purposes. Now, what happens if the purpose restrictions or eligibility requirements in the grant are not met? The GASB's PV says once the disallowed costs are recognized, there's a liability. And by the way, there's an expense that's recognized. Wait a second. That's exactly what we do today. Because if you have disallowed costs, you've got to declare an expense and a liability if those monies are supposed to be returned to the granting organization. So that's today's GAAP, pretty much the same. So to recap what we learned about in categorizing to category A and category B. First piece, is there some form of binding arrangement? Again, do we have to do something? If no, then it's not part of the GASB's revenue and expense project. Stop, do not pass, go. Is there some form of mutual assent of the parties, either by law, contract, or something? If no, then we might have category B. Do we have some form of identifiable rights and obligations that mean something? If the answer is no, category B. Are those rights and obligations, are they interdependent? Meaning to get something, you got to give something, meaning an exchange transaction. If no to those steps 2, 3, or 4, you're in category B land. And otherwise, you're in category A if you've said yes to all those. Now, for those of you who need a visual, it's over here on the left-hand side. So it's on the left-hand side. Otherwise, if you say no to something along the way, again, you're in category B, what we know today as a non-exchange transaction. So in our final segment today, we're going to talk about the all-important general aid to governments and shared revenue transactions. These are going to be subcategories to category B. Now, general aid to governments occurs when there's some form of legislation or law providing resources from one level of government to another level of government to fund particular activities or programs. The apportionment is based on some formula and may even have a base amount like our friends in K through 12 education where they have base aid. These laws usually provide for the timing of transactions, say quarterly of transfers or allotments. Usually there is some form of appropriation process attached to the aid. The GASB's view for general aid to government transactions is that, remember on the revenue side here this month, the resource recipient is going to recognize a receivable when payments are due if the following criteria are met. First, the resource provider has appropriated the funds for the providing of the resources and the period applicable to the appropriation has begun. The second piece is the resource provider has determined that it intends to provide the resources to the resource recipient. The receiving governments then recognize revenue simultaneously with the receivable due to the appropriation budget. So if you think about it, it's pretty much the same as today. Once the state budget is passed and then the allotments are done for K through 12 education, that's when you have a receivable and revenue that is there because the period has already begun. But if the period had not begun, well, then you got a deferred inflow of resources until the period begins. But wait a second, we happen to be in interesting times right now. What happens when a state government reneges? And I know my friends out there, who are especially in K through 12 education or other municipal governments, you're probably seeing this a lot. And it's not like we haven't heard that before, but maybe, with ARPA passing, with $350 billion coming to governments across the country, this might be alleviated. But the GASB believes that in circumstances in which the resource provider cancels its appropriation and communicates the cancellation to all of you resource recipients, well, then all of you would continue reporting a receivable and revenue if the state, in this case, expresses its intent to provide the payment in a subsequent period. So let's say, they decided to delay tax payments until May 17th, like the IRS is about to do. Well, if that's the case, that the state would then turn around and provide you aid on May 18th or May 31st, well, then guess what? It's the state still intends to provide you aid. But what if the state cancels the appropriation? Well, once that's communicated to all of you, no more receivable and no more revenue. If the resource provider says, "Hey, I have empty pockets," and they can't pay, so you would have to reverse that receivable and the revenue. Now, shared revenue is slightly different. There are two different transactions involved. The imposition of revenue, which is a tax, usually sales or gas tax or something else like that, and then the sharing of revenue between the governments. And it's the law or regulation that creates the situation for the binding arrangement. That makes two different recognition potential issues. The first alternative is for the shared revenue transactions that are supported through, say, monthly or quarterly allotments or appropriations. In those cases, revenue would be recognized by the resource recipients following the same proposals for general aid that we talked about a few seconds ago. But there's another piece to it. There could be continuing appropriations where no matter what, the government's receiving the shared revenue would then recognize a receivable for the underlying transaction that produces the shared revenue, such as, say, a gallon of gas, and you have gas tax. Now, that receivable would be declared and revenue declared if the resource provider has appropriated the funds for the providing of resources, if that's required, or if it's not required, it's not required. And the period applicable to the appropriation has begun, and the resource provider has determined that it intends to provide those resources. This is real quick, knowing that we're getting towards the top of the hour. These are some of the cases you might want to review in attempting to understand where the GASB is headed. And again, these are all in Appendix C. They're freely available for you. This is the revenue side. And these are actually pretty interesting, the fact patterns. I encourage you to print them out, dog ear them. I have them here. You can hear my papers right in front of me. I got them all dog eared and ready to go. And so I really think it's a good idea for you to have these handy as you think about revenue and expense transactions. And given the fact that there's not much different from today, you may want to have them handy anyway. Switch screens over here just to remind you of our coming calendar here. The end of April, it'll be our wrap up for going through the PV on expense recognition and how it all aligns to what the GASB has proposed for governmental funds. And for those of you who went through our financial reporting model webinar earlier this winter, well, that's pretty much the same thing on governmental funds. However, some of you might be pretty controversial. In May, we're going to head back into something other than the PV. We're going to revisit GASB 84 and 97 one more time for all you June 30 governments out there. And then on June 23rd, we're going to welcome the summer by considering other GAAP this year. That'll be 3 months at least of CPE are left for this 6-month period. Coming up over the latter 6 months of 2021, I can already tell you our focus areas are going to be GASB 87, that's for sure. And it'll be, we are just getting inundated from folks asking us questions on GASB 87. I'm glad a lot of you are thinking about it and intending to procure services on GASB 87. We are always here to help you. So with that, I'll see you in 6 weeks unless we have some questions out there. Amy, Brian, do we have some questions out there?
You know, we have a generic one here that says, I think it relates to the kind of the beginning. What about sewer and stormwater?
Sewer and stormwater. That's probably a perhaps it's a fee for service, depending on whether or not you're billed for sewer and stormwater. In my particular town, we're not billed for it. It's part of our property tax structure. But at each government's going to be different. So if it is a fee for service based on gallons, then once the gallon has incurred, the meter turns, and that's probably a category A. If it's embedded as part of your property tax structure, then it's a category B. Now, there could be some grant that's involved with stormwater. And certainly if there's grants that are involved with it, and if you have to construct a new stormwater system, as many governments do, or some form of separation process, which in a previous life I had to help finance some of stormwater separation. Well, that could be a grant project where you do have to perform some services, you have to do something, and it's a purpose restricted grant, and it may even have time involved. So it could be either category A or category B. But it goes to show you that something as simple as that, you really have to think about it if this does come to fruition in GASB standards. And we're going to have, if this does come to fruition, we're going to have to document all of our revenue and expense processes like we never have before. Anything else, Amy and Brian?
Just one more here. It says, but when do you recognize a liability versus a DI?
When do you recognize a liability versus a deferred inflow of resources? It all depends on time. And of course, the GASB still has the provision that it is the only one who says a particular transaction or accounting element does result in a deferred inflow of resources, but it all focuses on time. And so if you can't provide services until afterwards, after a particular time period, or it has to be used within a particular time period, then you have a deferred inflow of resources. Think about it in terms of taxes. If your government is approving your budget right now, but the budget starts on July 1st, all your revenue you collect between the tax levy of now and July 1st would be deferred inflow of resources. And with that, I think we're at the top of the hour.
We are. So thank you, Eric, and thank you everyone for attending. And we will talk to you next time. Have a great day, guys.
We'll see you next month.